Good evening. How is everybody doing tonight? Welcome to tonight for all of you that I haven't talked to. Happy New Year, happy 2020. Hope you had a great holiday season. Any of you who are just the free event members, I probably haven't talked to you yet, so hope you're off to a good New Year start. Welcome to tonight, Wednesday night, the 8th. As always, I like to finish these up in an hour for various reasons, including the fact so you know what to expect. And as usual, I believe as I put the finishing touches on the slides, I have way too much information as usual. This might be a little different for some of you. I always try to make sure that in everything when I teach on these webinar nights, and by the way, I do consider these totally educational. As a matter of fact, I have mentioned, but I actually was going to email all my seminar students. I'm going to do that tonight, just to remind them that I expect that all of these presentations that I do are part of their curriculum actually, and if they don't attend one, to catch it on the website on the replay, because there's a lot of little nuggets in all these, and naturally, if you're not part of the seminar program, you're not going to learn enough to learn how to do all this. That's not the point. But the point is that there are when you do learn, there are lots of little nuggets that a lot of times I've had some people say that, my whole career turned on this one line that you said, this one little thing, or it was a huge influence to me. And then it happened to me to some extent. I mean, I had a line that I learned my 6 month of trading that I never forgot. The Jimmy Rogers line. And sometimes you just need that little click. And that's what a lot of tonight is about, actually. While the topic is narrow in a sense, confirming what, I'll explain what that means. The implications are huge. And when I realized it, and that's why I put that little note on the last couple of emails saying that, this is one of those handful of times, like last year, 3, 4 times, I sent a little note saying, this is to me really an important presentation in a lot of ways. And I know when you sit through some of these, you maybe don't fully get what I mean by that, but I'm here just teaching you. I wouldn't be saying it for any other reason, but the reason is because I've worked with people for so long, and I'm just getting just so in the zone in terms of being able to understand how to communicate to people because I see the problems. And that's what a lot of tonight is about, is maybe realizing if you're trying to learn this, whether you've taken classes or not, whether you've taken it from me or not, wherever you are in your development, I think this will help shed the light on a lot of things, if that makes any sense. So with that introduction, I guess let's get going. I had this slide up there, so I'm not going to stay on it, but there's a lot of stuff going on the first couple of weeks here. I don't know how I backed myself up, I guess, because I had a little vacation, so now I paid the price. But there's coffee with Paul on Saturday. That's this little informal thing. I don't really prepare for that typically. If I do, I prepare at 8 o'clock in the morning. So it's been a very popular thing. I do it about once a month. It's a little informal get together, talk about whatever is interesting or on my mind or questions that you have. Wednesday is going to be a very important one to me. It's going to be, I haven't really done one of these before. It's going to be a long-term trading, investing review and analysis. Not all of you are able to day trade. Naturally, a lot of you are working jobs or whatever that you're not doing that. But everybody, if you're here, you have some financial interest, and everybody's interested in longer term. And I'm going to do a complete run through, everything from even touching on subjects that are not my expertise directly, such as financial planners and that kind of thing, and talking about the mix a little bit. Again, not my expertise, but getting specifically into the stock part of that and how you should handle it, and also reviewing the last year in my long-term trades. So it'll be, I think, a really interesting night, so don't miss that one. Naturally, you'll get invites and invitations and all that good stuff. And then Friday, a week from, not this Friday, but a week from Friday, is the intro class, which is the first part of the seminar program, which is open to all of you. If you've never attended that, I suggest you do. It's a 4-hour class that is just an educational class that is actually the first part of the seminar program. So that is going to be that Friday, and then the next day starts the seminar program for those of you, if anybody is signing up for that, that would be the date, the 18th, is the Saturday that actually starts the paid for part of the program. All right, so there we go. Confirming what? This is what was sent to you. I want to read this because this is understanding where I'm going is an important thing tonight. So using multiple concepts when they converge to select any trade is critical to success. But what concepts are you looking at, and at what point do you have paralysis analysis? You ever heard that term before? I'm going to make you guys talk a little bit. You ever heard that term before, paralysis analysis? Heard of it? How about giving me a number one if you feel you have or are currently suffering from it to some degree. Very, very common thing. And there's a good reason for it. Want to get the quick analogy? If the next time I went to my doctor's office, he said, "Hey, Paul, instead of giving you a checkup, come on in here. I'm operating on this guy," and he hands me a, what do you call it, a spatula? Or what do you call the doctor's knife? Is it a spatula? Is that what they call them officially? Gives me a spatula and says, scalpel. Yeah, scalpel. Why did I say spatula? Scalpel. Gives me the scalpel and says, well, um, why don't you? This guy has a little growth in his in his finger. Why don't you cut it out? I mean, I'd be a little paralysis analysis too. I mean, no matter how much I studied it, even if you gave me an hour to read a book or whatever, I'd be kind of like, well, I haven't done this. I don't get it. What happens? It's the same thing. It's just a simple thing that if you don't really understand fully what you're doing, you start to back off your own confidence, right? Another real good example that just popped in my head was, hey, give me a one if you've ever done public speaking of any kind. Give me one if you need any kind of public speaking. Good part of you probably have. I guess a third or half you probably have. Okay. Tell me if this is true for you. This is true for me. If I am a master of what I'm talking about, like if you want to talk about trading the market, I have no fear. I've talked in front of groups of how big? I was about 200 people. It was live in a room I talked to about the market one day, and I stood there and I said the exact opposite of what the two people before me said. that takes some that takes some guts, but I didn't care, and I was completely right. But I have absolutely no hesitation at all. But you put me in front of a crowd, and I don't know my material 100%. Even if I know it, but if I'm not an expert, don't you then feel very hesitant? True? Don't you kind of, you're nervous, right? You have the butterflies. I have no butterflies at all. If I'm talking about trading or anything, I really know. I mean, in a prior life, there was something else that I was good at, and I had no hesitation to talk. It's the same thing. It's not hard to understand why you have paralysis analysis. It's because you're not 100% sure what you actually should be looking at. And guess what? That is what tonight is about to some extent. It says here, it says, good traders should never suffer from that. Period. You shouldn't really be seriously trying to trade if you suffer from that, because it means by definition you're not really sure what you're doing. Now, there can be indecision, there can be close calls, but there's a difference between I know what I'm doing and this is a very close call and I'm not sure what I'm doing, right? There's a difference between those two. So we're going to talk about what you should be looking at in theory. Now, again, I always want to emphasize I don't want to disappoint in any of these. This is not a technical class where we're going to go through, those things. Obviously, that's what I teach on Saturdays. But this is more of a step back and talk about what stuff we should be looking at and not be looking at, and why you end up in confusion sometimes. If you notice from me, let me ask you guys: have you ever heard me? For those of you that take classes from me, have you ever heard me use the words confirming indicators? I don't think you ever have. I dance around it because some technical things, we look at multiple things technically, but I don't use that term because I think it's for the most part a negative term. Now, not completely, understand, I'll explain, but I think to a large extent because it leads to that paralysis analysis thing. I'm going to talk about a bad reason why confirming indicators exist. And then I gave you a quiz question. There's actually a slide about it, so you don't need to answer it now. But the quiz question was, confirming a trade to the extreme leads to question mark. Unfortunately, I only have a couple charts in here. This is not going to be a chart-rich night, and I know it's probably the only time I've done that to you in 2.5 years. But it just doesn't lend itself to it. In it, I feel these topics are extremely important. So let's begin. So that I know and I can sense that because this is kind of a weird topic, that some of you are probably confused about what we're even talking about. So let me jump right to the conclusion so that you know where I'm going. Okay, otherwise you may get lost along the way on this one, all right? So let's start with the conclusion so no one gets lost. Technical analysis is the process that correctly involves looking at multiple technical items. That's a good thing. That's what we have to do in technical analysis. Looking at multiple time frames is perhaps the most important thing to me. Taking multiple snapshots of the price pattern of a stock, and when it teaches, it's very clearly defined what you're looking in terms of time frames above you and below you and what you need to see. Not every time frames are all in, but that multiple view of a price action is probably one of the most critical things. You could call it looking at stock, future, forex, wherever you're looking at through multiple vantage points. There's a good movie by that name with Dennis Quaid. I think it was Vantage. It was called Vantage Point or something like that. It had the word Vantage in it. I know that. Dennis Quaid. Coordinating with the market bias. That is part of what is technical, is part of what I teach, that it is not always required, but depending on the stock and the trade you're doing, you may want to say that, well, today's not a day to take something short. I don't care what it is. You may say that. That's an optional part of your plan that you may want to do. These are things that we correctly involve looking at multiple technical items. Okay, you may want to look at the relative strength or weakness, something else that's taught in class, to give you additional odds. If the market is kind of sideways but not bearish, and you have a stock that's really bullish, that may have increased odds of going higher because it's getting the money that day. And all the technical concepts that we talk about, in other words, everything that I teach in class and the things that you eventually may personally decide you want to add as options to your stocks, your plans, the way that you trade, all of those things, that come together are all valid different things that we look at. I don't call those confirming indicators, and that's my point of this slide. These are all the necessary technical things that we look at, okay? It says right here, somewhere it says, there it is. These are all valid concepts and necessary to understand how to make money. But here's where the confusion comes from, where people now start to say, okay, technicals mean something, or technicals are good, but I'm not sure I fully get them. So let me confirm what I'm doing, okay? And my question to you is going to be, which of these are valid things to look at to confirm your trade? And this is where we're getting into the heart of today's conversation. The company's fundamentals, if it's a stock. Before taking a trade, should you check the fundamentals? Does this answer change if it's a long-term investment? Don't worry about answering now, because we're actually going to go through each one of these in just a minute here. Are the fundamentals, so in other words, what we're saying is, if you find a stock that you like for whatever reason, and I guess I'd be assuming you're not a fundamental trader, because then fundamentals would be the reasons you picked it. But if you find some chart you like for some reason, or you go to eat at some restaurant you like and you decide you want to go long the stock, should you confirm that decision by looking at the fundamentals? Same question. Should you be looking at recent economic activity in the U.S. before you go long as a day trade? Do you look at that? How about as a long-term trade? If I'm going to go long a stock, before I go long that stock, should I go and study the economic situation of the country to determine if we have interest rates that are going to hurt the stock market, or wonderful things like that that are discussed on the news all the time? Should that be something that I should put into the formula, a confirming indicator? Intermarket relationships. Look, here's a broad topic of stuff that's taught sometimes in terms of looking at the relationship between different countries and different currencies, and how the different economic situations exist, and if one goes up, what one's going to go down historically, all those good things, including the relationship between gold and interest rates, and oil prices and foreign countries, and everything, trying to tie it together. Does that help us? Recent news, if it caused the move you're playing. If you're playing some stock because it had good news a couple days ago and it's still moving up, and you want to know, gee, I kind of like the pattern here, but should I go see if that news justifies the stock moving up another day or two? And some of these things I'm saying, I have to bite my tongue to not add commentary at this point. Technical indicators, all the technical indicators, right? Can you list some technical indicators, just to see if you're still awake out there? Can you list technical indicators for me? So let me see if you know what they are. Most of you do, probably, and I'll add some to it. What are technical indicators? Give me some examples. Technical indicators. Okay, MACD, moving average, convergence, divergence. Moving averages are technical indicators. Relative strength indicator, MACD, yep, right. These are things that are part of chart packages, and the definition of a technical indicator, at least my definition, is that it somehow takes the past price action, computes a mathematical formula, and projects it in the future. Bollinger Bands are also, yes, and there are hundreds of them, literally hundreds of them, if you want to go look at all of them. Do we confirm or trade with those? In other words, before I go long, do I have to see the MACD actually crossed? Is that something that I should use as a confirming indicator? The tick and trend readings in the market, should I use these to confirm? The volatility index, should I use these? By the way, the volatility index, tick and trend, these are not technical indicators. These are unique other things. They're not, because technical indicators would be things that are taking the past price of your stock and projecting it forward. These are separate, independent things that give new information to us, but they're still in the category of a confirming indicator, right? Right. Technical indicators are all derivatives of price. The tick, trend, and volatility index are not, however, they're not a derivative necessarily directly of the price of any issue. Matter of fact, these generally apply to the market in general. So these are the things that I want to kind of talk about a little bit. Before reviewing this, though, let's step back and take a bigger look at this issue. What do I mean by that? Well, these are all very one-line definition type things. But I want to step back for a minute and just discuss this whole topic about what we should be looking at and why this is such, I think, a deadly topic to so many people. And when I explain this, I would love, I love the little LBs when people do it, like light bulb moment, like, wow, I really got through to you on something. I love seeing those. I understand that some of you will not really get what I'm saying, and some of you will, you'll try to get it, but you won't get it. Some of you may not like what I'm saying. Some of you may kind of get, and some of you may just boom, boom, boom. You know, I always hope 10 or 20% of you just have a moment where you go, wow, you know, this is really helpful. So if you have that, let me know. But let's jump back to the bigger issue for a minute, and let's step back and let's get the answer to this question that I asked you first of all. Why is this such a key discussion? Because the issue is actually the same issue that permeates all traders that have issues until they learn what to do. And I'm talking about the issue of, you know, the use of confirming type indicators to the extreme. I asked a question on the email invite that was sent to you. There it is. Quiz question for Wednesday. Confirming a trade to the extreme leads to what? Ready for the answer now. What's the answer to that question? Confirming a trade to the extreme leads to what? Yeah, excellent. Yeah, exactly. There's actually two answers, and I want to go through both of them, and you all nailed one of them exactly. And that first answer is just as you said, indecision, right? Yeah, it could be. Yeah, it could be that the indecision leads to a delay, right, Chip? And then you second guess yourself and say, oh, it's getting away from me. So then you take a really terrible entry because you didn't make the decision at the right time, right? Yeah. Right. Well, yes, true. Other than all of that, well, it can lead to two things. It can lead to losses. It can also lead to missed opportunity. And again, for some of you who've not heard me talk about it, it's in a couple other presentations. There is a saying out there that goes along the lines that missed money is better than lost money. And believe it or not, I do not really agree with that totally. It makes some sense. I understand we don't want to take crappy trades because we're bored, but on the other hand, it doesn't make sense. It makes sense when you're a new trader and you lose a lot and you don't know what you're doing. But when you're a good trader and you find the trade, you know, I don't look for thousands of trades every week. I look for, you know, a couple handfuls every week. And when you find the trade that you're supposed to be in and you decide to pass it because you were undecided, confused, or unorganized, that's not acceptable. It's just not. It's as bad as taking a stop out to me. And sometimes it's worse. A stop out, you lose one risk unit. Missing a good trade, you may miss 2, 3, or 4 risk units, right? So indecision is a problem. But there's another answer to this question. And it's called something that I really think is a big issue to a lot of people, and that's subjective perception. Do we all know what subjective perception is? The question is, confirming a trade to the extreme leads to what? What subjective perception is, yeah, I'm going to give you a quick one. Right, it's your belief on what you see. In other words, a good way to explain it is I'm gonna dive into this topic twice tonight. And again, I don't want any comments on this. I've just the broad topic of politics, as if we're in school right now. I don't want any political comments, please. But just the broad concept of politics is a good example of it. You know, there are people who are on one side of the political spectrum, and they believe what they believe. And then when they hear the opposing view, they go, that's lies, that's garbage, that's rubbish. And then when they hear what they want to hear, they go, yes, see, I was right, I was right, I was right. And both sides do that, of course. And if you never listen to the other side in a fair venue, you never really judge or properly analyze what's going on. So it means that you've already decided the answer, and now you're going to look at things and justify your answer regardless of what the facts are, right? So in trading, you have a stock and you decide you want to go long the stock for God knows what reason. You liked your dinner there last night, or you just heard it was a good thing, or you saw or heard a rumor, you saw somebody write about it, and you want to be long Outback Steakhouse or whatever it is. So you go and research it, and everything you read that's good about it, your brain puts it in the checkbox, bam, 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 got to get this. And everything that's bad, you go, well, does that guy really know what he's talking about? Well, that really doesn't apply, and you kind of ignore all that stuff. And it's the opposite of being objective, right? If you have that in science too, you can. Right, exactly. I think this actually started from science. I believe it originally was created in science in a sense. Yes, you're right. Confirmation bias, yes, same thing, right. So we're going to hit on that again for a minute, but there's the answer. So overconfirmation leads to this problem. But think about this, it's critical. New traders, right? New traders, investors. By the way, I call everybody a trader, TRADER. If you hold a position for months, you're a long-term trader. I put the word investors there sometimes because I'm afraid a newer person may feel that I'm excluding investments if I say trader. So I often say trader, investor, just so there's no confusion. We're talking about the whole spectrum of time frames. Okay. New investors, traders come to the market almost 100% subjective. What does that mean? Well, they come in and they don't have any planned concept attack on what they're doing. As a matter of fact, they probably don't even know if they're fundamental or technical or whatever. They probably say sayings that don't make a lot of sense. They come in and just, they'll look at a stock and say, well, prices can't go lower. Time to buy that has just dropped a lot. It's got to bounce here because it's dropped so much. And they'll go long on something. They'll say comments like prices are really extended, right? That was great news, so it simply can't fall anymore, right? These are comments that you hear from new people that really have no basis for, understanding or trying to figure out what they're doing. So the goal of a student of the market is to become as objective as possible, and this is a true goal, whatever your attack is to the market. And to me, it's a dead topic. There is no other approach to the market unless you have millions of dollars at your disposal. There's only a technical approach. But whatever your approach is, your goal is to become as objective as possible, correct? That's your goal, to do that. Learning that price action is the value of any stock at any moment, right? There is no argument to that. Nobody can argue that. At any moment in time, whatever that stock is trading at is what it's worth. There is no discussion about it. Learning the proper way to read price action, getting the confidence to trust what you know, and performing based on the above and following up to ensure that last one kind of is the crux of today. It's to say, what are you doing to make your decisions? Are you really doing these first three things? And then when you do these three things, are you actually using them? Do you have the confidence to say, look, here's what I know, this is what works, and boom, I'm closing my eyes to all these other things because they simply don't matter. I've learned that. And that's what you have to be able to do. You won't do that until you learn and until you get the confidence. So what happens to you typically? Well, if you are in the indecision category, if this multiple confirming thing just has you in indecision, you may find a stock that you like technically, but you just aren't sure because you're not committed to technical analysis. You haven't learned it well enough, or you think it doesn't work well enough. So you want other indicators to help you. So you check other things. You check the news. You don't like the sound of the news. You check the morning reports and see the GDP tick lower, so you decide it's prudent to hold off taking any long trade. That's the way you work under indecision. And these last two steps are meaningless. They're ridiculous steps. It's something you should never ever do because it will never help you. If you're subject to subjective perception, what you would do is you would have a stock that you find maybe it's just interesting technically, and that's all you can say because you don't have the skill or the confidence to say it's bullish, it's bearish, here's where you get in, here's where you get out. But you like the company and you want to be long the stock. but you've learned you need to be objective. So here, the problem is that you start off subjective and you say, well, okay, I need to be objective. So let me go find if it's true or not that I should be long this stock. But of course, what you do then is you go out and even though you think you're being subjective, you just, even though you think you're being objective, you simply subjectively go and find the information that confirms what you've already decided you're going to do. Now let's pause for a minute. Does all that make sense? A lot of these nights like this are about identifying pitfalls, things you do wrong, getting you in the right direction, trying to teach you some of the steps in that. For the rest of you, does that, I mean, seriously, does this make sense? I will gladly go back over some of this if you want me to, because again, this is no doubt in my mind a much bigger topic than the average person probably realizes. For one thing, if you're subject to this, it's kind of hard to diagnose yourself, right? It's kind of like, uh, saying you're an alcoholic. You can always say, well, I could stop drinking whenever I want to. I just don't want to. It's kind of like, well, yeah, I could look at some of this other stuff. I just don't want to. I'm doing okay like I am. Well, I'm not making money, but I'm getting better every month, and pretty soon I'll make money. Well, it's not probably going to happen. You have to stop and draw a line and say, look, if I'm not getting better doing what I'm doing, I have to do something different, right? So I'm going to take just a 2-second time out here because I know some of you joined late, and I know I'm going to run a little late. And when I run late, everybody, it gets kind of hectic at the end. So I just want to remind you of a couple things. This is the schedule coming up. If you were here at the beginning, you saw this. Saturday, Coffee with Paul. Next Wednesday, a really good talk about long-term investing trading. I'm going to run through a whole lot of stuff. Next Friday, a week from Friday, the intro class. You're all invited to all that stuff. And then after that, Friday starts the seminar program if you're going to sign up for that. Also, I just want to take 30 seconds. Just I want you to email me. But every time I bring this up, there's a dozen new people that say, "Gosh, I never heard about this," and they're thrilled. And again, this is not something I quote unquote sell. This is just information for you. I have a prop firm that I'm very comfortable, confident with, that I like, that I refer people to that are doing well with it. If you don't have the money to day trade and you want to, it's a place where you can be day trading in a couple days if you want to. You need to put up $5,000 and you can trade with $50,000 capital. That's the highlights of it. There's no loopholes or anything to go through. Your money's protected FDIC. So it's a great combination of all things. And you need to email me if you're interested in that. And if you are also interested in doing that along with the seminar program, there's a little combination package. But just email me if you're interested in any of that. I just want to throw it out there because every time it comes up, there's like a dozen people that go, why didn't you tell me about this? I've been talking about it for a year now. So, okay. So let's take a look back to the slide here again. Which of these are valid indicators to confirm your trade? So here's the list we had up there. I'm going to run through each of these real quick, one at a time. Yes, it is. This is recorded, and it usually gets posted like by the weekend or by Monday following 4 or 5 days. Or see, it's on the free stuff page. Okay. So let's take a look at each one of these. Fundamentals. I don't know if you can read that slide. It's kind of small there. I actually stole this off the internet. I don't know whose slide that is actually, but it's a common saying I used to hear all the time. Fundamentals tell us what stocks to buy, and technicals tell us when to buy the stocks. What do we think of that expression on that slide that I stole from the internet? What do we think about that? Fundamentals, what to buy. Technicals, when you buy them. I've heard that since I started trading. Boy, you're pretty crude, Glenn, man. I'm just kidding because that's exactly what I would say. No, it's complete garbage. It's complete garbage. Absolute garbage. Don't even consider it. Fundamentals are completely worthless. I don't want to run through the whole reason why, but next Friday that I just talked about, that intro class, I do go into fundamentals and why you should never even look at them. And I don't mean that they're not necessary. I mean they're bad to even look at. There is no argument. When I'm done talking, there is no other side to the argument. There is nothing to talk about. But just give you a couple quick examples. Um, the great example to me was when I was coaching somebody, it was a long time ago, and he said to me, Paul, here's my plan, and see if you follow this logic. Is there still the IBD 100? Is there still such a thing as that? I never really followed that. I know I had it my first year of trading or something, but is there such a thing still as the IBD 100? It's the 100 best fundamental companies in the world. Anybody? Nobody knows? It's the IBD 50 now? Okay, well, whatever. So at the time it was 100. So he said, Paul, here's my plan. I'm going to take the IBD 100, and that's going to be what I buy. And then I'm going to use technical analysis to, to buy them. I said, okay, let me ask you two questions. If you had an IBD top 10 company and it was in a downtrend, would you go long no matter what they said about the stock? And he goes, well, no, of course not, because I've been trained technically, I wouldn't do that. Oh, okay, all right. I said, what if I showed you the most beautiful technical chart you've ever seen? It was absolutely perfect, but it didn't make your IBD 100. Would you go long? He goes, well, yeah, I probably would. So do I need to even finish the statement? It's just a paper mache thing he's looking at. It's completely worthless. Yeah, I mean, kind of. It really did. Because, I mean, okay, so what are you looking at the list for? You just admitted to me that list is completely worth. Now, there's nothing wrong with having distinguished that from having a universe of stocks that you scan. We all are not going to scan 14,000 stocks every night down to stocks that trade 100 shares a day. So we need to come up with a universe, and if you want to use that for your universe, I don't care. But don't tell me that that's the only thing you can trade because of the fundamentals. And here's the other side of the coin as well. Some of the greatest trading ever in history, I just got the tail end of it in the late 90s, um, came about with stocks that went from $2 to $4 to $50 to $100. And you know what? They never had earnings. Never. Never. There are no fundamentals. You couldn't possibly trade them. The best stocks of the 90s all would be unavailable to you as a fundamental trader because they didn't have any, right? Now, some of those stocks went out of business. Now, if you take a stock from 20 to 60, do you care if it goes out of business after you sell it? I don't care. You know what some of those other stocks became? They became Amazon, and they became Google, and they became all kinds of companies you're very familiar with, right? We don't know. It doesn't matter. It simply doesn't matter. And when I talk about the other fundamentals on Friday, you'll understand. So this is just an obvious one. This is something you should never be looking at to confirm anything. How about the um, how about the economic activity in the United States or the world? What do we think about that? Do we want to understand the economy? And most of you would probably say for day trading, no, right? But what about long term? If I'm going to take a long term investment, something I'm planning on holding for months, should I be comfortable with the economy before I take the trade? Is that something that I should use as, we're talking about confirmation to say, I like this stock, but you know what? Boy, they just started to talk about interest rates going up. Maybe I better hold off. Is that something we should do? Should we look to the economy to confirm a trade, a long-term trade, let's say? What do you think? One answer? 80 of you here, there's one answer? You're afraid of me now because I boo-hooed the fundamentals so bad. Should we look at the economy? It's a fair question. I mean, for crying out loud, guys, CNBC and a host of other shows live completely on the concept of teaching you the economy. Isn't that true? Isn't that true? How can it not be important? CNBC and a host of other shows make their livelihood. Isn't that what they do, everybody? Don't they teach you the economy every single day? They tell you that what Trump does in the Middle East will affect your portfolio, and they tell you that when interest rates are going to go up, that it's going to affect your portfolio, and they tell you that the trade war with China is going to affect your portfolio. Don't they go through that day after day after day? Right. They do. But no, it's completely worthless. It's completely worthless to try and now. Don't get me wrong. I'm not stupid. I know there is some big, broad, loose relationship that the U.S. has a great economy. We have a great stock market. Yeah, but for you to even try to time even on a year-to-year basis, the concept of this is crazy. It's completely wrong. As a matter of fact, the truth of it is, and this is so funny to me that this isn't just brought out more, but the stock market leads the economy. Right. Well, you're good then, Ella. So just enjoy the conversation, but also make sure that you're not a closet fundamentalist. In other words, there's a lot of people who propose that they only trade technicals, but they want that confirmation. That's what I'm talking about today. Do you trust your technicals to the point that you could be on a deserted island, which is the goal where you should be? What was I saying about the economy? Do you guys realize seriously that the stock market leads the economy? Period. It's the easiest thing in the world to prove. Every crash that we've had, and somebody said there was a tough period of time in the 70s or something, but look at 1929, look at 2001, look at 2008. Every one of those crashes was not the result of a poor economy. None of them were. None of them were. Yeah, you get confused because after the fact, after the crash, what happens, everybody? After the crash, what happens? And on Friday, I talk about that too. I have that article with the 10 top economists that say they don't have a clue what they're doing, right? What happens after every crash? Yeah, then everybody comes out and explains to you why it crashed, right? And then everybody goes, oh, yeah, gosh, we should have understood that. No, the economy crashed because the market crashed. That's what's happened on every one of these. The market crashes every time it has. It's crashed from what Greenspan called irrational exuberance, supply and demand. Everybody in the world who wants to buy stocks is in the market, and everybody decides to sell. And that's exactly what has happened. Now, on the way down, new things start to happen, right? And sure, there's other conflicting things that happen, but that is what happens. In other words, you will never, ever, ever call a market top by deciding the fundamentals have gone bad in the economy. Is that clear? Is that clear, everybody? And you know what? You know why it's so easy for me to say that? Prove me wrong. Prove me wrong. I'll give you a 100-year window to prove me wrong. Or 100 years, it takes us to 18, 19, 20. Yeah, that'd work. 100-year window. Okay. So when you realize that, and the reason that people are slow to want to do this is because if I keep peeling away the things that you want to look at, i.e. your confirming indicators, you're left with nothing but one thing called price action. And that's a scary thing to some people because you don't understand it. Let me give you an example of something. Do you guys remember the inverted yield curve? You guys remember the inverted yield curve? This was, I think, August of this year, if I remember right. Do you remember the inverted yield curve? Yes? Don't know what it is? Don't have to worry about what it is. Let's just pretend it's like a big pink dinosaur that's going to swallow you whole. It doesn't matter what it is really for this conversation, but you can look it up if you want to, right? Now, you may not remember the yield curve inversion. You know why? You may not remember it because guess what happened? For a couple of weeks, everybody was standing on their head, and I mean almost everybody. You're gonna love this next few slides, by the way, right? Everybody's gonna Bloomberg, U.S. yield curve just inverted. That's huge, right? And you could pick all the slides you got. New York Times, stocks fall as bond market flashes recession warning. Long-term investment rates fall below the short, and that's what it is right there. It's when the long-term rates fall below short-term because they never should. It's called a yield curve inversion. It's one of Wall Street's favorite predictors of recession, and it happened on Friday. And you can just go back, and if you remember during that week, guys, true or false, everybody that week was on the TV saying, holy crap, end of the stock market, right? Recession, boom, boom, right? There wasn't even a question about it. True? Am I exaggerating or not? Ah, Glenn, you are always so far ahead of me. Here's two problems with this. Number one, there's three problems with it. Number one is right here. Here's what everybody always said. The yield curve has inverted before every recession since the Great Depression. Okay. What's the problem with that statement? Well, the problem with that statement is that we care about the inverse of that statement, not what that statement says, right? In other words, after every yield curve inversion, is there a recession, right? There's a big difference. Did you catch that difference, everybody? See, I'm a fan of statistics, and statistics are part of technical analysis. So you show me statistics that I can really hang my hat on, and I'll factor that into things. But the problem is that this statistic is meaningless. Listen to the difference. The yield curve is inverted before every recession. Okay, but the flip side of that, the negative occurrence, is every time the yield curve is inverted, it has not led to a recession. That's number one. Number two, the economy has become such a mammoth, incredible thing that there is no understanding it anymore. Every day is a new day in the market, in the economy, right? Every day is a new day. Do you know that if you went back like 20 years, 25 years, and if you told people that we were printing money at the rate we were in the national debt we've had, they would say that we would be a third world country. They would have bet $1 million on it. Yet here we are, top of the heap, nobody cares, right? Things change in the economy. It's a very flexible situation. Right, Ella, exactly. And the other thing is that you're gonna like this next one here. Look at this one. This is the same day. Mohammed Al Arian from CNBC. Inverted yield curve recession signal is distorted. What? What did you say? Is he saying that maybe there's not a problem? Key points from his discussion. If you live in an interconnected world, you have no choice but to import the effective negative policy in Europe. Blah blah blah. Basically, this is a foreign policy issue, not our problem. Well, he's saying that he's the only guy out there that said this yield curve thing may not matter. Now, there's a reason I'm getting into this. Believe me, I don't care about yield curves, obviously. But what does this leave you with in your mouth? There's two things. Number one, is he smarter? Does any of this even matter? In other words, why are we listening to people who are trying to use something to predict where price is going where we can do what? Where we can actually read where price is going? If things continue to go up and somebody's telling you they're going down, what are you going to do? But I want you to go back and get the second part of this. And this is something that was just mentioned by one of you in the room very astutely. And again, well, let me tell you what it is. I want you to notice these first two articles. These articles, go on to say it's the end of the world, basically. Who wrote this? Bloomberg wrote this one. Who wrote this one? New York Times wrote this one. Bloomberg and New York Times have anything in common? Now, I want you to be careful here. Again, I do not want to get into political discussion in general. It's not the point of this. The point of this is that here's a statistic for you, that there are some networks that have only 96% negative coverage of the current administration. That's a fact. Can't help that. New York Times and Bloomberg have political agendas to make things sound as bad as they possibly can, right? That's not a secret, right? And again, I don't care, please no comments. I don't care what side you are of the coin. I don't think that you can denounce that. I mean, you may agree with them, but there's no question what side of the political coin they're on. You come to CNBC, they're kind of neutral or on the other side of the coin. So it's amazing how when you see something and you want it to be terrible, it's all of a sudden terrible, right? So again, you come back to this thing, what are you listening to? What's the point of all this? And if you're confused and spinning your head, that's the whole point. None of this matters. It's all just crap. I'm in the business of selling news to the public. Are you really, Alfred? But I mean, again, that's something else to consider is that, and the point of it is what news you're even listening to. And what's the point of news when you don't even have any concept of the people saying the news, don't have a clue? I mean, none of this matters. And the point of the whole thing, again, is that this all just goes to solidify that there's only one thing. And today, more than ever, more than any time in history, there's one thing we should be looking at, and that is learning how to understand price action, because that is what is happening. It's not what somebody says should be happening. It's not what some company tells you should be happening. It's not what somebody who's trying to sell their million shares of stock tells you should be happening. It's what's actually happening. And that's why it's so critically important. The last concept here is a different category of stuff. As a matter of fact, remember when I do that Friday thing? One of the things that the top 10 economists stated that they disliked is that they're politically motivated in their economic readings. I mean, they admit that. In other words, they will skew the political outlook to suit the political party they favor. If they like the people in power, the economy is great, right? They admit that they do that. So again, how true is it? How true isn't it? Nobody cares, because none of this matters. I'm trying to get you so far removed from any of this being close to something you should ever look at, is my point. Now some of you we're already there. You're saying, okay, Paul, this is fun to hear, but I already knew that. Some of you, this may be shocking to you. You're like, how can you tell me the economy and fundamentals don't matter? They don't. They, guys, it's not that it doesn't, it's maybe the wrong language. It's not that they don't matter. It's that they're already built into the price. And the reactions to things that are said are already built in, and you always head in the wrong direction, right? The next couple things are different here. Technical indicators, tick train readings, volatility index. These are objective type things, and they can add some value. News, don't pay attention, but reaction. Yeah, thanks, Alfred. I mean, that's actually a quote right from me, and I say that all the time. It's not what happens that matters. It's the reaction to what happens that matters, right? Somebody says blah blah blah, big red bar. Okay, that's fine. Now, where are we going from now? That's what I want to know. So that's always the issue. And that's where you get into charts. That's where you learn from a chart. That's where you understand and learn from a chart. Let's talk about these next ones here real quickly, though, because this is a different category to some extent. Technical indicators, tick trend readings, volatility index. These things are technically oriented things. Now, first of all, technical indicators, I discussed on the Friday Introduction to Mastering Technical Analysis class, which comes up a week from Friday. But the bottom line is that they simply are not useful because they're just taking past price action and projecting a new line, which we can already see on the chart. And what I said is if you like to use one as a frame of reference, which is what I do with moving averages. Moving averages are technical indicators. That's the only technical indicator I have in my chart, or a couple of moving averages. I use nothing else. And I use them for a general reference. I'll explain that more on that Friday. But that's fine if you want to pick one and do it. But they are never a buy indicator. They're never a sell indicator. You get fooled by these because people can show you. Like if you ask me right now, if you gave me 5 minutes, I would show you 10 charts where I could prove to you that you simply buy a moving average crossover and it works. What's the problem with that? Well, because I probably had to look at 50 failures to find the 10 that worked. That's the problem with that. So you can always find whatever you want to try and prove something. That's not helpful. What's helpful is to, over a large stream of charts, over a large period of time, over different time frames and different environments, does this concept work? And that's why it's important to understand reading the price bars themselves and reading the price bars over multiple time frames, because that's what matters. Rallies on a 1 minute chart don't necessarily negate a bearish daily chart, things like that. So the next thing here is that the tick trend readings. Now, there are some things I have to admit I used to use. I used to use the tick and the trend. I haven't had them on my charts in years. Why not? Somebody tell me why not. Tick and trend readings, I'm not even going to explain what they are, but they are technical things. They are things that are taken from the broader market numbers. There's some usefulness to them, and they are exactly what we would call confirming indicators. The tick readings are like the number of upticks versus the number of downticks at any moment on the entire market. The trend's a little more complicated, but I mean, they're things. Yeah, okay, you guys are real close, but my line is they've never made me money. They've never made me money. Yeah, I mean, I used to have them up, and I just realized one day, you know what? Price action is what matters. It's just what matters, period. That's a line I say all the time, RC, is just, if it doesn't make me money, it's a waste of time, it's a waste of my resources. And the tick and trend, I had up on my charts for a decade, you know? And I think I used them, but for one thing, I do believe they lost effectiveness to a large extent because of ETFs and that type of thing. And whether they have or not, to me, again, it's that big confirming indicator. You know what? I don't want any confirming indicators. I want to read a chart. I want to look at that chart and I want to say, there's go right there. Boom, that's it. I don't care about anything else. And actually, we're going to come to a slide that you've never seen before that I really love, the three-legged stool thing, in just a minute here. So, and let me show you the last one here for fun, the volatility index. Now, the volatility index, when I say this to you, some of you are going to tell me I'm an idiot. I don't know what I'm talking about. I've used it for 2 decades. I know what I'm talking about. And I have used the volatility index in some rare instances to help find a market top or bottom on a big time frame. Using the volatility index intraday is a complete waste of time. Sorry, if you do, Please prove me wrong. I've been saying it for a long time. Nobody's ever proved me wrong. What people do is just what cracks me up. It's so hysterical. They'll say, well, Paul, I want to confirm that that's the market low today. This is today's 5-minute chart, right? You know how I confirm that? Well, the volatility index topped at the same time this one went lower. Well, there's just a perfect inverse relationship. There's just a perfect inverse relationship to these two. I mean, if you think, if you're trying to figure out if this is a buy, it's the same issue if this is a short. If this says sell and it fails, well, this is going to fail. There's nothing to learn here at all. As a matter of fact, the use of the VIX is when it doesn't confirm what's going on, when it takes its own path for some reason. That's the only time it's any value. But all the time I hear people say, oh, Paul, the VIX is running into resistance, therefore the market's along. Well, okay, the market's running into support, therefore it's along. What's the difference? You're not adding anything to the equation at all. So this is, for the most part, this is the especially when most people use it. Now, the use for it is to understand complacency. I'm not into teaching the VIX right now, but I don't keep it on my screen for what it's worth. But the only use of it is complacency. If the market is dropping and the VIX isn't going up, that's where you're more likely to see it continue to drop, and nobody uses it that way, but that's the only partially useful way to use it. So the bottom line of this is very, very simple. What I do is that I learn price patterns, and I have no distractions. I think the best way to trade is to be on a deserted island with a laptop that only has your chart feed on it, has no news or nothing else, and to be disconnected from the rest of the world and simply trade the charts that are in front of you. And that is simply the best way to do it, because nothing else helps you, and most of the stuff actually distracts you to the point that's a very negative thing. One last quick thing, and then I want to show you the closing slides, and unbelievably I may be close to being on time here. I also said in here I want to show you something too. There's a big reason, a big bad reason confirming indicators exist. Can anybody tell me what a big bad reason confirming indicators exist? Big bad reason. I'll give you 2 examples. One of them's a bigger reason, one of them's a small reason. Yeah, well, you guys are smart. Right, exactly. They sell Holy Grail marketing for trading company. Yeah, that's exactly right. CNBC wouldn't exist. Really, I mean, if if everybody in the world decided, yeah, the charts where it's at, CNBC wouldn't have a whole lot to talk about. Don't look now. Goldman Sachs is saying the economy is nearly recession proof. That was like today. It's recession proof. We're never going to fall. They're talking 5-10 years of an unquestionable rally. January 2nd, they said that, right? Of course, investors could be excused for getting a little nervous. Such optimism was also heavily in late 2007, just before the economy was about to enter the worst financial crisis of the decade, of the year, of the century. So again, who cares? People say these things, they make big comments, the world's falling apart until we rally 5,000 points, and now we're going to go up another 10,000 points and we fall. It just doesn't matter. But the other thing is this, and I hate to say this, but it's just simply true. Until I started DTS, I was never I was never running a company. I was never more than an employee anywhere and restricted to what was going on. But we had so many classes at the place that I grew up at, Pristine. There were so many classes there. I'm not sure how many there were by the time it was over. I really don't even know. I mean, it was a couple dozen. I don't know. I don't even know. It was a ton. And at some point you have to ask, are you really learning more, or are you just watering down what you already know? Yeah, see, that's the point, Glenn, exactly, is that, look, if I draw you a little circle, and this is why I created these 3 classes exactly, and that's why I say to you all the time, what I teach is what I do. What I do is what I teach, and there's no fluff in there at all. So if I told you, here's everything you need to know, right? But what if you didn't know that's all you need to know, right? And then I say, well, here's some more information. Here's intermarket analysis. Ooh, that sounds good. Here's 75 other uses of volume that you're never going to use. Ooh, that sounds good. Here's this, here's this. But the problem then is what happens is, here's your knowledge data bank, and all this stuff is meaningless. And what are the chances now that you're going to be able to pull out the stuff that you want to pull out, especially when you're new and you're learning this? Does that make sense, everybody? This is what I mean by watering down stuff and by adding fluff that only confuses people. I literally have 5 or 6 other classes right in my folder I could throw up and teach if you wanted me to. But all that information together, all of it together would not add 5% to what you need to know to make a decision. And to, quadruple what I teach, to add 5% to the knowledge database, does that make any sense? I never thought so, and that's why I don't do it, right? Yeah, spaghetti face. It almost is that does look like a guy with two eyes and a bruise on his cheek and bad teeth. Yeah, I end up drawing a face there. What do you know? Here's a crazy idea. You want a crazy idea? Well, let me just. This is actually something I was going to put in an email one day. I have so many, like, I have a whole list of email ideas and other seminar ideas. I mean, not seminar, but webinar ideas. Before I go on, let me just add to that. Because I've been part of this conversation, and you just need to know this when you go to other companies. Like, there's a really big company, the one that absorbed Pristine, and they have 7 different trading rooms and 22 different classes and 35 different instructors, and they're just throwing stuff on the wall, and kind of whatever sticks is what works. But the conversation always is how do you sell somebody a big ticket item? The $15,000 seminar. You know how you do it? Well, you sell them the $5 thing or the free thing in your email, right? Learn, get my book on how to trade options and blah blah blah. And when you read that, you're supposed to like it enough that you come to the site and you sign up for the class that's going to teach you how to trade, right? And it's cheap enough that you go for it. It's $900 or $600 or 14, whatever it is. But then, of course, when you get done with the class, you find out, guess what? Well, you know what? There's a lot of good information here, but you really want to master this, you need to learn this, this, and this, right? You've probably all been through that. And that's simply something I don't do here. Read my website. My website opening down to the bottom where it says warning, that hasn't changed since the day I opened. There may be a typo or two on it, but I didn't even want to change it because it is what it is. And it's just the honest, upfront approach to what it is. And if you like it, great. If you don't like it, you don't. But it's just honest that I enjoy doing this, and that's why I do it. So here's a crazy idea. And then I'm going to show you one other slide here. Don't leave for this last slide because it's a good slide. As a matter of fact, this last slide may be the biggest thing I could get across to you. I've mentioned it before, but I never put it on a slide. Here's a crazy idea. Learn what is happening, not what someone thinks should be happening. Learn charts, learn them the right way. It's not hard to learn, but there's probably 50 times more information in technical analysis than most, that should say, ever understand. Than most ever understand, right? Don't even want to talk about it, Rakesh. Everybody's entitled to one mistake in their life, and I went to help a former student. It was what the situation was. The good thing was I was going to retire, and the good thing was that the couple of months there got me interested in really helping people, and that was the good thing about it. The bad thing was I went to help a former student, and I got a little tricked. Also understand that this is not engineering or architecture. It is not an exact science. Listen to this carefully. It's not an exact science. It's probabilities, and there will always be some art involved. Not art vandalay if you're here, but art. Your art increases with knowledge, experience, and confidence. Biggest mistake people make. I see people with enough technical knowledge to make money, but they don't. And their answer is, listen carefully, to try and go from learning from 85% technical understanding to 95%. In other words, they know charts pretty well. They know charts well enough that in my view they should be making money. They're not making money, but what do? They say, I got to learn more technical analysis. Or worse than that, you know what they do sometimes? They switch from stocks to Forex, like that's going to matter, right? If you can't trade stocks, you can't trade Forex, or you're going to trade futures or whatever. If you can't trade one, you can't trade the other. It's all the same thing. Don't ever let somebody tell you that you need different classes to trade Forex and futures. Again, that's just a scam, right? You still listening, Glenn? Right, Glenn, one of my students. You trade pure futures, right? Correct? Yep. And 2 of you here are Forex traders, right? Who are your Forex? I don't know if you're logged in. A couple of my students are pure Forex traders, right? I mean, it doesn't matter what you trade. It's price. We could eliminate the bottom of the chart where it says the time frame. We can eliminate the top where it says what it is. We can eliminate the right where it says the price. All that matters is the bars, right? So they try to increase their technical understanding, but sometimes that's not the problem. Their other skills are at zero. And here's the other skills. Here's the infamous slide I've been promising you, the three-legged stool. And the more and more that it's funny when you teach, it helps really solidify what you're saying. The more you teach, the more you try to explain to people, and the more you realize that what you're saying is hitting home and where the problem is. And this is what I want to get across. Here's charts. Superior technical understanding is one leg of the stool. Must be taught by someone who lives it. Not a free video, not somebody who teaches to teach, but somebody who lives this every day. And anybody that ever has heard me teach knows I live this every single day. You have to really get down to that last 5-10% of understanding what technical analysis is about. But you know what? You can have all this and still lose money. Because the other leg of this stool is psychology and or experience. They're all kind of rolled together. Psychology, confidence, and experience are a little circle, a little unsolvable circle is what it actually is. Learning properly at small risk builds confidence and becomes experience, which is the enemy of psychological issues. Does that make sense, anybody? People ask me, how do you get over psychological issues? And the answer is through confidence. And how do you get confidence? You get confidence from experience. How do you get experience? You get experience from losing money, is what it comes down to. Does that make sense, everyone? But you have to master these psychological issues. And the best way to do it is to learn what you're doing, step number one, like a pro. And then I go through it in class, but then you build into a winning concept. You don't start off even risking what you would consider to be a small amount of money because it adds up too quick. And when you have any money at risk at all, your brain's not functioning properly. Your brain shuts down almost immediately when you risk real money because you immediately could become a loser. And you can't stand that, right? Right, and that's all part of it. I can't even go into all that stuff right now. But then there's a third leg of the chart to me, and that's called math and probabilities. And in this concept, and this may be hard to even understand or explain, but to me, the best way to sum up this concept is a quote from, you'll tell me who in a minute. I said this all my trading career, and I don't know if I got it from him or it was just a coincidence, but I'd rather make money than be right. Some of you don't understand that. I know that. I know it almost seems esoteric, but there's a lot to this statement. I'd rather make money than be right. There's many times on a chart I'll say, you know what? I'm not really sure if that's moving up or not, but you know what? I'm getting in right there. Because the math and probabilities tell me the chart is okay, and the math and probabilities tell me I'm doing it. It's hard to explain that one. Who said this, by the way? Don't make me turn around and look at in my cabinet. It's Mark, yeah, Douglas. And it's something I've always believed and lived my whole time. So that is my presentation for you. Let me know if you have any questions. Free stuff page, DTS, free stuff right there. Go to free stuff and you can watch all of these prior events. This one tonight will be posted there by the weekend or so. Thanks, Alfred. Comments? If not, we'll officially call this an evening. And remember, if you came late, if you want to be a day trader and you need the money, email me. There's a prop program that's been around. I've been talking about for a year. I'm not part of it. It's just simply a good service to you guys because some of you, I think it's a good concept if you want to trade to use prop money. All right, guys, have a good evening. We'll talk to you later.